Hello, everyone. Welcome to the market update here for Tuesday, December the 20th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. That's Jerry at TradersPro.com. All right, let's get started. Obviously the market has kind of continued to sell off. This is not surprising. I've been talking about it since the end of November, although the market is trying to bounce a little bit today, and it could rally a little bit. We'll look at the charts here in a second. One of the biggest reasons is that we're getting into a very bullish historical time of the year, and the market has sold off for 4 or 5 days in a row. It doesn't usually, markets don't go straight down, just like they don't go straight up. And so you have to allow for, little rallies or consolidations within these moves. And so it's not shocking, but I wouldn't be looking at today as a reason to run out and say the drop is over. In fact, just the opposite. The drop has not damaged the market sentiment, and the sentiment still is way too high. There hasn't been any fear in the selling yet, and that should scare some people because that's a pretty decent drop we've had off the highs, and it's created really absolutely no fear in the market. And that usually means, in the context of the way the chart looks, it usually means that we're just getting started with this decline, and it could get really ugly before it's done. So it's going to allow us to be very cautious still in the portfolio. We'll talk about that when we get to that part of the class. But as far as the direction alert, still in a bear market. The momentum has come all the way to the left side here. We're now in the extreme reversal risk area right here. What does that mean? Well, it means that we've gone down a little bit too far too fast, and we're getting into a position here where we could start to get a bounce or a little bit of rally. That's why it's not a shock that the market is trying to rally today. That's why we're using these indicators, is they tell us when markets reach these extreme levels. Remember last week, what was I talking about last week? We were going through these direction alerts. I was saying, the market we're right in the middle right here, and the market was basically from this indicator standpoint was saying, hey, we could still go either way right here. We could continue in the trend direction. That's usually what happens, is it's telling you when you're in the middle, is it's telling you whatever current direction you're in is probably more likely to continue. That is, unless you're seeing reversal candles or something like that are showing up. But basically last week it was suggesting that, hey, we're not in an extreme level yet. There's still room we could decline. Now we're starting to get into an area where we could bounce a little bit. Now, we can still get to the far left side of this range. So it's not suggesting that it can't go down further right here. It's just suggesting, from a momentum standpoint, it's suggesting we're entering into this area where it's getting extreme and we could bounce. Now, ideally, what you'd like to see is both momentum and breadth get into that extreme reversal risk area at the same time, and that's what we're not seeing. If we go to the breadth or the breadth indicator here, we're right in the middle. We're in trending in market breadth, which is suggesting that we're not at an extreme level. So, with just one of the indicators they're still, to me, what this is telling me is that this attempted rally today is probably nothing more than a bounce. Maybe there's a little bit of follow through to it, but likely that we're going to continue to decline once that's over. Now, maybe it holds up. It could be, like I said, this is a very bullish period of the year. By the way, that doesn't always mean the market goes up. Sometimes, especially in years where the conditions are more bearish, it just kind of stays flat, or you have an up day or down day or a couple small up days in a row or something like that, and then everyone can call up the Santa Claus rally, get their Santa Claus rally out of the way, and then but it also means that it's probably the first part of January is where it can really get ugly, when people start realizing, hey, everything's flashing recession coming up, and we know that markets don't bottom before recessions. There's never been a recession where the market has bottomed first, and so that's another reason to believe that there's still more downside and it can still get pretty ugly. Is the market just hasn't reflected a recession yet, and really the drop up to this point, in my opinion, has just reflected the rising of interest rates. It's not reflecting the economic conditions yet. The market isn't trading or factoring in that potential recession. And I have to say potential. I think it's going to happen. I feel pretty, unfortunately, I mean, just knowing how these things tend to end and knowing that the Fed is determined to push the economy into recession, because that's what'll defeat inflation, or is more likely to defeat inflation. It's just, from a probability standpoint, it's pretty high that that's what's going to happen. So anyway, so market breadth still in the middle, and then you get to sentiment, and sentiment is all the way to the far right side. This is very rare, by the way, very, very rare, where you see sentiment at the far extreme overbought range and momentum at the far oversold range. It usually, a lot of times, it means that something big is about to happen. Now you say, okay, well, could it mean that there's a big rally that's about to happen? That's always a possibility, but again, from a probability standpoint, it's just the opposite. It's telling me the market is selling off here, and there's no fear at all behind the selling when there should be. That's what it's telling me. So I'd still be very cautious. I wouldn't be getting too aggressive. Now, there are some things I'm going to add to the portfolio today, but it's very specific actually to the conditions we're in, and what's likely to hold up even if the market does sell off a little bit further. Buy-sell ratios getting a little bit extreme here. Sells outpacing the buys. It's getting a little bit wide here. Now, it can get even wider, as we've seen, but this is starting to become a little bit extreme, to where we have to start to pay attention to that. And like I said, it's what we've already seen, that the market has dropped a little bit too far too fast. We get bounced a little bit. And you would expect it to when it starts to widen out like that. Again, these are relative indicators. You kind of look at, you're in kind of the relative range where you start to see it come back towards each other again. Doesn't mean it will or it has to. Like I said, it can become even more extreme, but you just recognize it's just telling you when the market is looking like it's getting a little bit stretched. By the way, you'll use these indicators for a while. And because you may need a little bit of help seeing overbought, oversold, but pretty soon you can just recognize this all on the chart. You just look at the chart. I can see the chart, how far we've dropped in 4 days, and that's, from a relative standpoint, that's a pretty decent drop. Usually you'll get some sort of consolidation out of that. And so I don't always need an indicator to tell me that in the near term a market is oversold or overbought. That'll come with time and experience. But until then, the software is very helpful to help you recognize those conditions. And but that's why we go through them. We go through them. I teach you how to use them so that you can start to develop that. But remember, what we're doing right now is we do this process every week, and it may seem a little bit mundane or boring, but we're trying to determine, gathering all the clues of what the market is looking like right now, what the trend is, how it's acting, the price action, all this stuff. We're analyzing to try to determine where the market is more likely to go in the next few days or so. In this case, we're usually doing this every few days. We'll have another class on Thursday. We're trying to determine the market trend. Is it trending up? Is it trending down? Is it trending sideways? And we're using that information then to determine what to do. Are we going to be buying stocks? Are we going to be on the sidelines? Are we going to be we're not usually shorting stocks, but I have implemented that inverse ETF strategy, which has done very well over the last week for us. These will go up when the market goes down, but we got to determine whether the market looks like it's going to go down before we implement those strategies. And so we're just trying to gather in the clues, and not only are we analyzing the trend, but like I said, we're analyzing where we are we within that trend. Is that rubber band getting a little bit stretched? Have we gone down a little bit too far too fast? We gone up a little bit too far too fast? That's what these indicators, these first indicators, are kind of telling us is are we at any sort of extreme range? This is mildly extreme, like I said, where we're at right now on the buy-sell ratios. And so that's good to recognize. In a bullish type of situation where the buys are outpacing the sells right here, if it would, like it did back in these areas right here, then that could be telling you, yeah, the market could go up a little bit further, but it's starting to get stretched, and I might stop buying at that point, maybe tighten up stops in kind of a bull market condition. In case it starts to come back down, it'll stop me out. I'll be able to keep the profits I've made. So in other words, there's decisions you can make based on these different indicators, either to get into trades, get out of trades, adjust stops. So this first part is just gathering that information. Okay. The sentiment indicator, again, dropped very sharply on the last few sell-off days right here. We're getting close to a little bit oversold. Could bounce a little bit if it gets down to this area down here. By the way, if the market does move sideways, a lot of times it can alleviate those extreme conditions. It doesn't always have to go in the opposite direction. We don't have to rally in the next few days to alleviate a little bit of a near-term oversold condition. We could just kind of bounce around sideways. That'll tend to alleviate that a little bit. You'll see these indicators move towards the middle when that starts to happen. All right, let's take a look at the chart. Now, hold on here. Hold on just a second. All right, back last week I was talking about I had some key levels here. I had 395 and I had 389. 389 was the biggie. I said if we dropped below 395, I said that would be very bearish. It probably mean we're heading down to 389. If we drop below 389, that was kind of my signal of working towards the bottom down here. Now, it doesn't mean it's going to go straight down there, but once we broke that 389, it made it much more probable that we're going to come back down and retest that bottom down there. And it still looks like that's where we're headed. Again, notice the behavior of the move over the last few days. This is what an impulsive move looks like. Impulsive means you're moving sharply in a direction. It could be up or down, but there's a definitive direction. There's no like argument as to the direction. It's very important you learn to recognize the difference between an impulsive price behavior and corrective. Impulsive, it means it's moving sharply in a direction. Corrective is more choppy, more sideways. That's reflecting indecision. Now, indecision isn't necessarily a bad thing. It's just a kind of a regrouping or trying to figure out what to make of the previous impulsive move. But it's important because these two are very important to be able to recognize, because again, you're trying to analyze probabilities, and from a probability standpoint, whenever you see a corrective move, whenever you see a move that's more choppy, more sideways, you want to pay attention to the direction or what was the previous impulsive move? What direction was it moving in before that corrective move? That's the direction the market is more likely to move in once that corrective move is complete. So if the previous move was up, impulsive move was up, it was going up, and then it was more choppy, more sideways, the higher probability is it will continue to go up. Now, the key word there is higher probability. It's not absolute. But you're going to find that if you can learn to recognize these basic trend fundamentals, you're going to be right a lot more often than you're wrong. And that's going to allow you to make more money than you're losing. You're going to make money, you're going to lose money. The goal is not to eliminate losing money. You can't do that. It's to make sure that you're making more money than you lose. And in my earlier classes I used to teach a number of years ago, I used to liken it to running a business. You understand as a business owner, some of you are business owners, you understand it's impossible for you to only have profits and no expenses, right? It's impossible for you to sell shoes but not have to buy more inventory or shoes. It's impossible for you to have a building that you don't have to pay for the electricity or whatever. It's impossible to not have expenses, right? But so what's the goal of your business? It's to make sure you're bringing more money in revenue than what's going out in expenses, right? It's real simple. But yet so many people get in the stock market and they lose their common sense. They expect that they're going to only bring money in and that they're never going to have losing trades that has money go out. And so they have an unrealistic view of how it's supposed to work. And that's why many people just struggle with trading and hate it, or they feel like it's not fair. No, it's perfectly fair. It's you that has to change your mentality. You have to look at it from a business standpoint as opposed to some unrealistic Santa Claus that delivers you money down the chimney every single day with nothing you have to do on your part or no cost to doing the business. Okay, that's really what our goal is we got to make sure that we're making more money than we lose. And again, part of this is understanding how to read these trends. Now, what's kind of happening right here is when you get trend reversals can be sometimes pretty easy to spot, because usually what you have is you get back-to-back impulsive moves in the opposite direction. So you get impulsive, corrective, you'll get impulsive up and then impulsive down, and then you want to pay attention to how it corrects, because now if it corrects, you've got impulsive down. You tend to alternate between impulsive and corrective. So with that corrective move, you're likely to have another impulsive move down. This is clearly an impulsive move down. We have a little bit of a rally day today. We'll see how long that lasts, but let's say we move a little bit sideways. If we move a little bit sideways, that's going to be a pretty clear indication from a probability standpoint that we're still moving lower. Now, how much lower? Well, then, we look at other things. We can look at, previous support resistance levels. Obviously, that's a biggie down here. That was the October low, had that big reversal day. There's a little bit of support right in this area here, a little bit of support right here. You could look at. You could start to focus on a little bit of what's going on there. Now, we could still be in an impulsive move. Just having a one-day rally doesn't mean that's corrective. But like I said, it wouldn't shock me this time of the year being a little bit more bullish. that you see it, try to bounce a little bit or move a little bit sideways, probably ultimately leading to another move down once that's complete. All right, hold on just a second here. Oh, a question on the buy-sell ratio. It's taking the number of new stocks that have buy signals versus stocks that have sell signals. It's not saying what's being bought or what's being sold. It's just purely off of it's looking at the entire market. How are the new buys are there now more buy signals and sell signals? And right now there's more sell signals than buy signals. It's starting to become a little bit it's starting to become extreme, because when there's a ton more sell signals and buy signals, you have to wonder if it's that rubber band is getting stretched. Does that make sense? So that's what that buy sell ratio chart is looking at. By the way, there's training videos on all the indicators as well if you need more details. Otherwise, I'd be explaining with all the new people we get every week. I'd be explaining the details of those indicators every class, and so the recording videos are there to give you the basic understanding of what you're looking at, and then I come into class and tell you what it's telling us right now, what the indicator is telling us right now. So just be aware that there is that support there to be able to review the education, to be able to review what that indicator is actually looking at. You can go and review those so you get that understanding. All right. And now most of the other charts are looking about the same. The Dow, again, looks about the same. Now, could you make an argument that this is a bullish ABC pattern right here? Wave A, wave B, wave C. You could, and it's definitely a possibility. If we started to really rip higher from here, then I would be saying, yes, maybe that's possible. It's a bullish ABC pattern. The problem is, though, again, it gets back to probabilities. Very rarely will a wave B go beyond the beginning of a wave A. So if this is wave A right here, wave B typically will not go above that area. It can, and that's what adds a little bit of doubt into the analysis. It is possible, okay? But if it does, usually it barely goes higher, which this did, okay? But it just happens so rarely that I don't assume that that's one of those rare situations, okay? Because one of the problems is that if you look at too many possible patterns and focus on the possibilities, you can always find possibilities. I mean, as bearish as the market is looking right now, Chairman Powell could come out and say there's no sign of a recession. We're dropping interest rates tomorrow, and the market would probably fly off of that. And there's no other technical hint that was going to happen, right? There can be low probability events and movements that take place. But that's why you have to try to focus on the probabilities. Now, let me give you an example of how I would switch that. Okay, it is possible that could be a wave B and this could be a wave C. Not probable, but possible. If we started to rally up into this area right back here, get back above that 389 area that was so important. If we got back above that. Then and it was very impulsive looking, meaning we had several really big bullish days that pushed us right up into this area here. Well, then I've got to look at this and say, hey, maybe this is that rare, what we call this an irregular ABC pattern. If wave B goes beyond the beginning of wave A, we call that an irregular ABC pattern. Like I said, it doesn't happen very often. And so if you're seeing a bunch of these, or think these are jumping out all over the place, it means it's it's not. It means that you're looking for the lower probability outcome, and what's probably more likely to happen is you're in a trend reversal and this thing's more likely to go lower. But like I said, if it started acting more bullish and really strong impulsive, now you have impulsive down, impulsive up. That's what happens at market bottoms a lot of times. You go impulsive, corrective, impulsive, corrective, impulsive down, impulsive up, and then you have corrective. You start to alternate again. You get an impulsive move up, you have to look at the possibility that now you're reversing back into an uptrend, and that could be one of those rare, irregular ABC patterns. Like I said, and even if you do have one, wave B would barely go above the end of wave A. If you had a situation where it went all the way up into here, no, that's not you're no longer dealing with an ABC pattern. I don't care if the stock started to take off right there. What you had is this was the correction. You had impulsive up, and then you had impulsive down, and then you had a rare situation where you had impulsive right back up again. But that would not be a corrective pattern if that wave B is way up here. It's just it just goes against all the characteristics of what an ABC pattern is. It's more choppy, more sideways. Here you're advancing the trend. You've actually gone to a higher high right there. All right. The NASDAQ. Now, NASDAQ's not too far away from that October low. Now, what have I been saying this whole time for the last 4 months or 3 or 4 months or so? I've been telling you that although the Dow has looked pretty strong and it's had a pretty strong rally off those lows, off that October low, the Dow stocks are not the leadership. The leadership tends to be the NASDAQ 100 and the Russell 2000. And so, you go back to the Dow chart, it's like, okay, yeah, but the Dow's looking really strong with this move right up here. Shouldn't that mean then that the NASDAQ stocks will eventually take off and follow it? Again, it's possible, but that's not normally what happens. Normally, the Dow is following the NASDAQ. So in this case, what it's telling me is that NASDAQ is still leading. It's leading the way down. It just hasn't shown up yet. What should start to happen is the NASDAQ goes lower and then the Dow starts to follow. So I would expect the Dow to have a much bigger drop during the sell-off. And we've seen it on some of these down days where you'll start to see it have a bigger move down than the other indexes. That'll tend to probably show up a little bit more later in the move, but that's something that you'd be looking for. But if you look at the Qs, again, this is what always bothered me about the Dow rally is that the NASDAQ just did not confirm it. It was more sluggish, more choppy, and now it's been dropping pretty sharply, and we're not too far away from breaking that low. And so the idea here is that it would lead the way lower, lead the way below that October low, and the rest of the market would follow. By the way, I am pretty bold in my analysis of the market going lower. I've shared this a number of times. You can go back and review. I'm not going to go over it again today, but you want to go back and review probably about the last 4 or 5. Actually, it started right there that last day in November. Or it's like that, or when did we have that last class? I don't know if it's December 1st or right in that area there. End of November, beginning of December, I started seeing everything lining up on the charts, and I'll talk a little bit more about as far as the VIX is concerned, why I think that's the case. But I don't get this bold very often, because I don't see a lot of these factors line up like they have. Now, having said that, I'm a trend trader. If suddenly this market started to take off, as bearish as I'm sounding right now, I'll flip the switch and I'll start looking at the reasons why if there are clues as to why the market could keep going higher, I'll be talking about that. So if you're brand new and you're trying to gauge my personality a little bit, all I care about is getting the trend direction right. And I'm not trying to be right. I'm not trying to brag about, hey, I told you so, and I knew it was going to happen. I want to make sure that I'm not leading everybody off a cliff. I want to make sure I'm getting the trend direction right so that I can help you and make it worth your time to tune in during the week and listen to me. And if that means I've got to flip-flop because that's what the trend of the market is doing, man, I will do it very quickly. Those of you who've been around for a while, you've seen me do it. And it's happened sometimes within the same week where Tuesday, oh, we're going to drop. Everything's pointing to dropping, to Thursday. It's like, oh, we got this strong bullish reversal. Hey, now it's looking like we can go higher. It can happen that quick sometimes. But again, I get it. It's not popular to be bearish, but it's definitely right to be bearish when the charts are telling you to be bearish, and that's what I'm seeing right now. By the way, if you're just starting out, a lot of this comes down to a lot of the basics of reason why I'm bearish comes down to the fact that we have bounced off of this trend line, this declining trend line, perfectly during this whole move down. Every time we've hit it, we've gone to a lower low. We hit it here, went to a lower low, hit it here. Actually, this was above that line, but just on that opening day, and then it dropped. And so, we have the question mark, but we're assuming that it's heading the lower low until it doesn't. But that's another thing too, is if we were to break that trend line and close above that trend line, you're going to see me turn bullish. You got to at that point. At least in the near term, you got to recognize that that's pretty significant if the market were to push above that area there. All right. Russell 2000. Again, all these are showing a little bit of a bullish reversal candle there. Now, why am I saying today's a bullish reversal candle? Well, because we open lower, we open down here, and if things hold, again, we have an hour and a half when the market closes. We could fade into the close, and it could look a lot different. But if we were to close near the highs of the day, that means we closed higher than where we opened. That's the first time that we've done that significantly during this whole decline right here. We tried to do it on Friday, at least I'm looking at the Russell here. Let me go to the SPY again real quick. But see, on the SPY, we didn't do that on Friday. But even the Russell, it was more of a compact indecision candle. We had tail intraday high and intraday low up here. The body was pretty small. That's an indecision. But if we do close higher than we opened today, it's not a strong bullish reversal, but it is a bullish reversal candle. Usually you'll get a little bit of an upward move off of that the next day. It could be that it opens higher and then it reverses back down again. Sometimes you'll get a bullish reversal followed by a bearish reversal. Now, what I'm doing here is I'm reading the price action. Okay. Here's a good example. Here we had a drop. We opened lower right here. We closed higher than where we opened. So we reversed that downward move. That was a big downward move, but a little downward move there. The next day we did open higher. We opened up here, but then we had a bearish reversal. We closed lower than where we opened, and then we opened down the next day. By the way, when I start reading the candles here, it's what we call the price action, the daily price action. That alone is very short term. You're not going to try to draw a long-term conclusion out of a price action that's designed to be very short term. Okay, but for instance, let's say we rally up a little bit here, and then we get a gap up, and then we're trading lower than where we opened. So it'll be a red candle. It's up. We opened up here. And down, and we closed down here after a little bit of a bounce. the price action is suggesting we should go down the next day. But if I combine that with the chart, you got impulsive down. This might look corrective back up a little bit right here, and then you're getting a bearish reversal candle. I can use that bearish reversal candle suggesting we should go down the next day and say, based on the trend, we should be working our way down to these lows. So this bearish price action, in my mind, would be triggering a bigger bearish move down or bigger drop. But the price action itself is just very short term. But if I combine it with the larger chart pattern, then I can make those bigger conclusions. For instance, when we had the CPI report came out back here, we had this big bearish reversal candle. We opened all the way up here. We closed all the way down here. That was suggesting we should go lower in the near term, and we ended up doing that. Again, we didn't have a big. Maybe there was there was arguments for a big conclusion there too, because you were bouncing off that trend line too. So you were coming below that trend line, had a big bearish reversal candle. So this is just suggesting we should go lower in the near term. The fact that every time you bounced off that longer term downtrend line meant that you went to a lower low. That would be your conclusion, that you'd have a bigger drop. So when we had that bearish reversal candle, I was pretty confident we were going to get a bigger drop at that point. Hopefully that makes a little bit of sense. If not, oh crap! My screen is frozen. Shoot, let me see. Let me restart it here. Pause it and start again. Can you see me now? Can you see the pen drawing here? I don't know why that froze up. Thanks for letting me know, though. I would have hated gone. So I don't know how far back it happened. Here's that downtrend line. I don't know if it was back that far. Anyway, I don't know how long the screen was frozen for. All right. Looks like everyone's able to see now, though. Okay, good. Well, it looks like I started to get comments about 4 minutes ago, so it doesn't look like it was too much there. All right, hopefully it wasn't too bad. Sorry about that. Thanks for letting me know, though. If anytime you think it's something's off, sometimes if I'm just talking, I'm not pointing anything out. Sometimes I'll have the chart up and I'm just talking, but yeah, if it sounds like I'm pointing something out on the chart and it's frozen, yeah, let me know. Hopefully I can get that sooner, recognize that sooner. All right. Now the bond market has made a pretty big move down today, and one thing we were talking about was back in here was the fact that this looked like a trend reversal. You had impulsive down, impulsive up. This looked more corrective. Now this still could be a wave C. This could be wave A, wave B, wave C, and I'm still looking at that as that pattern. We would need to start moving up though pretty quickly here because you already have wave C. Wave A and wave C should be about the same length, and you're getting to a point where wave C is a lot longer than wave A. It's right at the point right here where it could still be okay, but it would start to need to move up. It goes down any further, and we'd have to start talking about this being an impulsive move down. And maybe we're reversing back down into a downtrend in bonds. But I think bonds have turned the corner. I think this is just a still part of the correction. A little bit of an indecision candle today. Doesn't always mean it reverses off of that, but if it closes near the highs of the day, that actually be a little bit of a bullish reversal candle, and we'd see if that causes the bond market to rally a little bit. By the way, as far as candles go, I have a whole training on candles. If you go to the YouTube channel, go to youtube.com, type in TradersPro, subscribe, and you'll get access to a bunch of these training videos. And I spend a lot of time on some of them. I have a whole series on candlesticks. I teach about everything you can learn, almost everything you can learn about candlestick charts. If you want to go there and review some of that. Gold has been rallying, and I've been pretty bullish on gold. I continue to be bullish on gold. You know, it had a little bit of a consolidation into here, but I think it's starting to break out again. It's acting like it wants to go higher. I pointed out on this longer term chart, we kind of broke this downtrend line right through here. Again, that's what I'm talking about. This is impulsive, then this is kind of corrective. This is not totally impulsive up through here, but it's been kind of back and forth. But this is clearly an impulsive move off the bottom. It's still acting like it's in this trend reversal. So I'm assuming, and then you tie that into, you've got all the uncertainty with what's happening in the economy right now. Gold tends to do very well in inflationary environments, and we're definitely in an inflationary environment. And so there's some fundamental reasons to be more bullish on gold as well. Oil. Now, oil, I talked about how I was turning a little bit more bullish on oil. We did drop a little bit right through here. We're kind of back up again. We had this little impulsive move off the bottom. We had impulsive down, and kind of a little bit of impulsive move up. It's possible, though, this could just be a bearish ABC pattern, maybe wave A, wave B, wave C. And then it could roll over again and drop. You know, I'm going to be turning a lot more bullish on oil when it can get up closer to this high. This is a lower high right there. If it gets up, right now we're at about a 50% retracement of that drop right here. We're about halfway. It can go a little bit deep, higher than that. 1.8% is a Fibonacci level. If it gets up above that, though, up in this area right here, it's more likely that it's reversing back up. But there again, you can look at the longer term chart of oil, and basically it's been moving sideways for the last, or choppy, really choppy the last several months. So there's still a lot of indecision, in other words, with oil, a lot of back and forth. Although some of the oil stocks some of them look pretty good. I still think it's if you're looking at an area that has been held up pretty well during the market sell-off, it's been oil. We've had oil trades before. I have a few that I might be looking to get into again. So it's been an area that's done pretty well. The dollar continues to trend down. Pretty clear it's acting like it wants to go lower. Again, at some point we'll see if that changes. We are in the extreme reversal risk area, so we are getting a little bit oversold. But again, you can move all the way to the far left side of that box, so we can still go lower. But it's important to recognize that we're getting a little bit stretched to the downside. Remember, though, that doesn't always mean that you have to rally. What could happen is that you see the dollar move choppy or sideways, kind of like it did right through here. It could just start to move more sideways, and that would alleviate. You'd start to see this indicator work its way back to the middle here. You'd see it start moving off of that extreme level there. So that's why you got to be careful. That's why we look at the trend and the overbought, oversold, because if you look at just the extreme, we're oversold, that means this is going to go up. I'm going to go buy the dollar right now because it's oversold. Well, you might be disappointed because you might be just sitting on something that moves sideways and then goes lower. It doesn't mean it's going to pick the bottom. We want to be able to read that trend behavior. So what would I look for as a potential bottom? Well, first of all, you'd probably be in an extreme oversold condition. And then you'd look for an impulsive move up, meaning you look for a sharp move up that kind of breaks you to higher highs, breaks above some of these other lower highs. That would tell me, oh, maybe we're reversing back into an uptrend. Still not strong evidence of it, but the impulsive move up would be a pretty strong indicator. And then how does it correct? How does that first correction look? Does it pull back in more of a choppy sideways behavior? Well, that's what an uptrend does. It's got impulsive, corrective, and then impulsive again. It would look more like that it's going to continue to move up. That's what we were looking at with the bonds. We had that sharp move off the bottom, and then it started to move a little bit more sideways to indicate that it was acting more like an uptrend. All right, the VIX. This has been a big argument as to why I think we have a lot further to drop. And what I've been doing is going and looking at the actual VIX chart. This is the one you can trade, and if you don't have access to a way to see the actual VIX chart, and the reason why the software doesn't have it is because you can't trade the VIX. You can't trade it purely. You can trade it in one of these little ETFs or ETNs is what they call them. But I have another charting service that I use, but this is a paid service. There are free services out there. StockChartscom is one that I use a lot on my phone when I'm just looking at stuff real quick. If you're using StockChartscom, just within the last couple of weeks, you have to put a $sign in front of the ticker symbol. So you go $sign and then VIX. On this charting service, I just type in VIX and it pulls it up. Now, what is significant about this? Well, the VIX is a very complex indicator. Like I said, if you go to the YouTube channel and search for my class on the VIX, I go into more detail. But what we're looking at basically is it's measuring the level of fear with the big institutional investors. My layman's definition of the VIX is it measures the level of freaking out by the big institutional investors. Not the average Joe trader that probably doesn't know a whole lot of what he's doing, but the professional traders have been doing this for 30 years, and they're the ones trading all your retirement funds out there. It measures their level of concern or freaking out. Now, there's a couple levels that you have to be aware of. Now, this can change. Okay, these are areas that we tend to focus on, but they can shift a little bit. But typically 30, when you get above 30, this is the fear level right here. I have a big line across here if we see it get up to that level there. That tells me that the big institutional traders are fearful. 40 is going to be very significant because this is panic. Now, why are we really focused in on this? Well, because there hasn't been a major market bottom. As far as I know, I could be wrong on this, but as far as I've ever seen, there's never been a major market bottom without a panic sell-off. And if you want to quantify panic, one way you could do that is seeing the VIX get above 40. 40 is a minimum. It should be a lot of times well above 40, but 40 is kind of that minimum. So if you're trying to tell me that the October low in the market was the bottom, we never got to 40 on the VIX. In fact, during all these declines we've had the whole year, we have never gotten not even to 40, let alone above 40 on the VIX. There hasn't been a panic sell-off. Now, why is that important? Well, because that tells you that you're getting close to a bottom. Doesn't mean it's the bottom, but it's one of the first clues that you're acting like a bottom and you're getting pretty close. And so this is telling us we're not there yet. Okay. Now, again, these are probabilities, these are absolutes. We can't know exactly. Maybe this is the one time where the market bottoms without a VIX going above 40. It could be that way. But again, are you going to focus on the lower probability outcome? If you do, good luck in your trading career. I don't know how you can do it. Because then everything's possible, right? You got to have some sort of structure to what you're doing. And the best way to do it is to try to go with the higher probability move as much as possible. Try to stick to the higher probability outcome and higher probability move. Now, not only are we not just even fearful yet, let alone panic, but we're not even fearful. Oh, by the way, the opposite too is when we gotten down to 20, this is a level of complacency. We're not concerned. This is where every sell-off has taken place. You go back to that, I'm going to just go to the SPY chart right here. You go back to this declining trend line right here. Every time we've hit that trend line, we've had the VIX down below 20 or down at 20 or below. And it's caused the market to drop after that, meaning the VIX to spike up. Look what's happened over the last couple of days. The market has dropped and the VIX has dropped. Now today it's up a little bit, so that'd be the normal relationship. You know, the VIX is down when the market's up. It should have an inverse relationship. It's moved in the same direction. What that tells me is that there's no, as much as we've dropped off those highs, there's no fear in the selling. Now you say, well, yeah, but Jerry, that means that they're not worried that there's going to be a sell-off that you're talking about, which means the market's going to rally. It could be, but in the context of the chart, we're almost back down to 20 again, where the market in almost every case tends to sell off. I think we're at a critical spot right here. Any move lower, the next move lower is probably going to start spiking that VIX up, and they're going to start seeing the concern. Now, one of my theories behind this is that we're in a unique time of the year. Hold on, I want to make sure my screen isn't frozen again. Question, do we need to see the VIX at 40 to see a bottom? It doesn't mean it'll be the bottom. It means that that's the minimum of what we would expect. It means we're probably in the bottoming process at that point as the VIX gets above 40. We get that panic sell-off. A lot of times, if you remember back in the financial collapse, if you remember back then, we had the big market sell-off when all those banks were about to go under, right in September, October of 2008. The VIX spiked well above 40, okay? But then guess what? We tried to rally, and then when did we bottom? We bottomed in March of the next year. So we still moved a little bit lower, but that was the signal. That was the shock signal that, hey, we've started the bottoming process. So bottoming processes can take several months sometimes, but at least we know that we would be closer to a bottom at that point in time. I think that the next question is related to what I'm about to talk about. The VIX. Now, one of my theories about the VIX being down with the market down, you got to remember what's causing the VIX to move is these big institutional traders buying protective puts. If they all start to buy those protective puts, means that they'll protect the trader's position. If the market goes down, these puts go up in value. So it protects them to the downside. If they have to sell a lot of shares, then they're protected. They can sell as many as they want at that point. They have those protective puts. Those will go up in value when the market goes down. The problem is you've got to buy those protective puts. And so you can see, if you're thinking like a big institutional trader, it's like, okay, I might need this protection, but if I spend all this money on protective puts and I don't need them, the market goes up, I just wasted all that money. That eats away out of my profits, okay? On the other hand, though, if the market starts to tank, I gotta have that protection. But then guess what? The protection becomes more expensive. Those puts get more expensive to buy. So the dilemma is, do you buy the protection when it's cheap and you might not need it? Or do you chase the protection when you absolutely need it, but it's twice as much or 3 times as much money to buy? That's a dilemma, okay? So this is where we start to learn about human nature. It's like, okay, it seems real simple. Buy the protection. Well, wait a second here. That's not that simple. If you bought all this protection and the market rallied, that guy might get fired. His boss will be like, wait, the market just rallied and we're at break even. How did we not make money on that rally? Oh, I bought all these protected puts because I was afraid we were going to drop. Oh, well, I don't need that. You're fired, right? Even though it's probably a smart thing to do at the time, but there's actual consequences for this. So it makes the decision a lot more complex. Now, my theory is a lot of these fund managers get judged by year end. We're a week and a half from the end of the month, the end of the year, the end of the quarter. It's a big ending on December 31st. I think these fund managers are looking at this saying, okay, December tends to be a bullish month, or at least sideways. We rarely have big sell-offs in December. I'm going to roll the dice, and I'm not going to buy that protection I probably need to see if I can get through to the end of the year so I don't eat into these small results here. If you're getting results this year, the market's been down all year. And they're trying to roll the dice on this, hoping that the seasonality will hold up. But guess what? If we drop much further, especially if we have a really sharp sell-off day, they could be looking at this as, okay, this was bad, but if we do this for the next week and a half, I'll be okay. But what if we have this? At some point, if it looks like that low is going to be threatened, some point, I think today's attempted rally is testing that threshold. I think if we get a little bit lower than this, especially if it's a sharp day, it's a down day, and everyone's looking at it, and it's like, uh-oh. Because guess what? Everyone at the same time is going to be going, uh-oh. And then guess what everyone at the same time is going to do? They're going to run to go buy those protected puts before they get too expensive, and you're going to see sharp down, big spike up in the VIX, and we're sitting at that area where it could happen. Now, it could be that we do move sideways through the end of the year, but then guess what? The same problem is going to happen in January, and it's probably going to happen the first trading day in January where it does that and the VIX spikes. So I can't tell you exactly what's going to happen between now and the end of the year, but that's one of my theories as to why the VIX is down with the market down. I think these big professionals are trying to roll the dice and hope they don't have to buy those protected puts. And but they may, and if they do, we're going to see it spike. Jerry, does the VIX influence the market or the other way around? It depends. It could be both, because so many people are looking at it nowadays. It used to be that hardly anybody knew the VIX or even knew how to read the VIX. But it could be that we're going to, like I said, it could be that we're going to rally from here, and the professionals know it, and that they don't see a reason to buy the protected puts, and this should be a clue to go buy. Okay. But if you're going to come to that conclusion, then you're ignoring all the other analysis. You're ignoring the trend of the market right now. You're ignoring the fact that we bounced off that trend line again. You're ignoring the fact that we went to a lower low right here. We broke this uptrend line right here. We're breaking below this little support area right here. Okay. Now what am I doing? I'm focusing more on the possibility than the probability. That's the problem. But it could be that the professionals are right, and we're going to have a big rally and all look stupid. That's okay. I don't mind that, but I'm seeing just the opposite. Now there are times though when I would look at the opposite. Let's say that we've already had a sharp drop and the VIX is up. Let me go back to the VIX chart here. Let's say the VIX is up in this area right here, and the market goes down and the VIX goes down. Well, that's telling me that we might be at a bottom because the professionals aren't too concerned that we're going to go any lower. They don't feel the need to keep buying those protected puts. I'd start looking for some sort of bullish reversal, but the chart, the stock chart at that point would be down, and then you'd be looking at evidence that it's starting to move up. It's just the opposite right here. We're still near a high, but we're not seeing fear in the selling, and that's a bad recipe. All right, I'm over time here, so I got to hurry. I'm going to skip through. There's really not much in the other charts that we need to focus on. Bottom line is that the market is still looking like it wants to go down. What we could be seeing today, and even today, look at how we backed off the highs. Now we're looking more like an indecision candle. We'll see how it looks at the close in an hour, but I just don't think it may bounce. It may try to hold up for a little bit here, but I don't think it's going to hold up. And so from that standpoint, I wouldn't be doing anything big right now as far as buying anything. And as far as the portfolio is concerned, how am I positioned? I'm positioned, 3 of the trades are inverse ETFs, meaning that these are going to go up when the market goes down. And then I have my gold trade, which is actually doing very well today too. So right now I'm positioned very well for everything. You got my gold mining stock, a nice move today. I like this. It broke out of this area right here, came back and kind of retested it. Looks like it's getting back above it again. Like it's maybe turning the corner a little bit. And if not, I've got my stop down below here. If it drops down below here and stops me out, so be it. SOXS, this is the inverse of the chip stocks. Now it's down a little bit today because the market's trying to rally a little bit, but had a nice move down, up from those lows. So as the market moved down, this is going to go up. This is going to go in the opposite direction. Allows me to still be long the market, not have to short things, because I don't like shorting stocks. Too much risk involved in that. Now I'll reevaluate these at the end of the day. If it looks like if we close near the highs today, I might get out of a couple of these inverse ETFs because I don't want to lose money if the market's going to rally a little bit, because these will go down if the market goes up. This is the SARK. This has done very well too over the last week. So I may only hold one. I don't know which one yet. I'll have to just look at things. And see how things close. Maybe I will hold them all. If the market really fades in the close, I'll probably hold them all. But probably the best choice is just to sit on the sidelines, not do anything in these types of conditions. Now, real quickly here, under the muscle stocks tab, people come to class for some ideas. So again, the conditions wouldn't make me want to buy too much in these conditions. But if you go into the new buys, this NINE looks pretty interesting. This is an energy oil stock. Again, it looks like it's been consolidating through here. This looks impulsive. This looks corrective. It should lead to another impulsive move up. It should break out and go higher. You got a little bit of a triangle pattern right here as well that would be very bullish, but breaks out. If it breaks out, what you can do is you can take the base of the triangle, which would be this move down right here, project that from the breakout, and it gives you a target area. Very often the stock will move about that far when it breaks out. So it started to break out today and it's backed off. You might want to wait to see if it can break out above there. You can also switch this to the signals. It's showing a buy signal right now, but again, if you look at the chart pattern, you might get a little bit more confirmation if you wait for the breakout of that triangle pattern, and especially in these conditions where we could get a big sell-off here soon, another big sell-off. I'd want maybe a little bit more confirmation on that. But that's one I liked out of that list. The other one was LW right here, the consumer staples. Kind of the same thing. You got this little, been trying to break out of this area right here. You have this little V-shaped move. Overall, the trend has been up. If they can break out of this area right here, that'd be pretty bullish. And then again, I'll have to look at these on Thursday, but I have wanted to add some coal stocks. There's BTU, but I like CEIX a little bit better. The chart on CEIX. You got kind of this little bowl-shaped move right here. This looks like a little bit of a correction back down, then a nice solid bullish candle there. You could wait for it to go to a buy signal or to move up. That's why I'll take a look at that on Thursday. I'm not really looking to do anything today. All right, that's all I have. Have a great week. We'll see you on Thursday for the stock-specific class. And I'll try to spend a little bit less time on the chart analysis or the market update stuff, and spend a little bit more time on some potential charts to look at. Sometimes I get going with, sometimes it's sparked by questions. I get someone new, and if I haven't reviewed something for a little while, today was kind of the VIX a little bit. Haven't talked about the VIX for a little while, so I talked a little bit about it today. So I'll do that from time to time. But what I'm hoping to do is not just keep repeating the same stuff in each class to where it gets too repetitive. All right. Thanks, everyone. Have a great week. We'll see you Thursday for the stock-specific class. Bye now.